So welcome everybody to our second episode, Invest in Passively in US Multifamily Show. We have a special guest with us today. We are very excited and hope you get tremendous value from the special guest we have today. For those new tuning in, I am your host, Jefferson Ortiz, and my co-host, Jonathan Ortiz. We partner up with passive investors to acquire large multifamily properties and get double-digit returns. Our main focus are in the Sunbelt region, which include North Carolina, South Carolina, Atlanta, Tennessee, and the whole Sunbelt region. In today's episode, we will be covering unveiling lucrative opportunities and much more. And our guest today is someone very special to us here. So I'll give you a little background on himself, and then he'll go ahead and give you guys a little background. So his name is Prashant Kumar. He is a father, he is a husband, he's a mentor, he is a CCIM, he is a managing partner of Cashflow Champs based out of Long Island, New York. With 25 plus years of strong technology background, he's responsible for acquisitions and marketing, where he maintains a strong, transparent relationship with current and prospective investors and property owners. Prashant is also involved in capital raising to ensure the transactions close and has handled every aspect of real estate syndication, from acquisitions to negotiating contracts and closing the deal. He has a very impressive record and portfolio. From what we got here, so his current portfolio value is around 100 million, has gone full cycle on 5 deals, and has about over 1,200 units. He's also focused on assisted living space and is the owner of 2 assisted living facilities, 150 units and 60 units, which I know we'll get into a little bit further. So thank you so much, Prashant, for joining us today, and welcome to the show.
Jeff and John, thank you so much. It is my honor to be part of your podcast today.
Thank you so much. Thank you so much. And we'll just kind of get it started with just give us a little background on yourself. I guess how you got started in real estate, and a little story on your first multifamily property to give the audience who may not know about you.
See, basically, I started real estate, by force. A friend of mine forced me to come into real estate, and because of him, the first thing I did was I hired a mentor. And the day I hired a mentor, I paid $5,000-$6,000, and it was a lot of money back then. And I said, listen, I have to make that money. I have to take an action. So, and I ended up buying 3 single-family homes in 3 months. But then realized that I cannot keep on buying these single families because it takes a long time. So at that time I pivoted. In 6 months time, I decided, it is not for me. I need to jump into slightly different asset class. And I happened to do a lot of research. I found a wholesaler. I ended up buying a 24-unit apartment complex. It took me more time to buy a single family home than buying a commercial real estate, an apartment complex. And that's where my eyes got open, they were popped out. The first thing I want to make sure that I want to tell you why I said that I hired a mentor, because that forced me, because I invested money, and not that I was a novice, but hiring a mentor forced me to take an action. If it was a free mentor, I probably would not have started the way I started. Okay, just to be very clear. There's a psychology behind hiring somebody, taking the guidance and taking an action, because I was like, man, I have spent so much money and I need to get that money back. So I took an action, and that led me to take the action. I bought 3 homes, and they were cash flowing homes, not bad. I still own one of them. I sold the remaining 2. And then I moved into multifamily, 24 units. The best thing about that deal was that I closed that deal in 17 days.
Wow.
Those each single family home took me more than 3 months to buy. And I had to send, and those small homes, $150,000 home, $130,000 homes, they were taking so much time. I have to prove my net worth. I had to prove my cash flow, blah, blah, blah. Bank will keep on asking 100 things all day long. And this thing I bought, cash flowing assets, I had to send my personal financial statement. I had to send my statement of, real estate owned, and boom, bank gave me the loan. I probably spent maybe half an hour dealing with the bank in the whole closing process. And I said, man, I'm not going to go back to single family homes at all. That was my beginning into multifamily space. And that asset, I own that asset, and that's a cash flowing asset for me. I mean, I probably spend maybe 15 minutes a week at most, and I get good cash flow out of it. 70 days worth of work, and then 15 minutes a week, getting good cash flow out of it. So I said, guys, I'm gonna jump into multifamily, and and obviously you cannot buy a lot of real estate yourself because obviously money dries up, right? So then you get into syndication. So that was my progression, single family to owning single families, renting them out, owning multifamily, renting it out, and then jumping into syndication, finding very, good people around me, having a team of good mentors, having a team of good syndicators, and I started working with them, and rest is history. I'm just in the multifamily syndication space. I still buy multifamily for myself. I have a business which is syndication, but whatever I make, I invest in my personal portfolio also. So that was another point which I wanted to make was, yes, syndication is good. It will give you the cash flow, it will give you the money, but whatever you make, if you don't want to pay, and again, I'm not a tax advisor, if you want to shield that, invest in real estate, in the cash flowing real estate, so that money can start making money for you also.
Wow. No, I'm blown away, Prashant, by your story, and it's really interesting. I know you mentioned mentors and people that have already done what you're looking to do, in working with them. For those people that may not know, Prashant is actually our mentor in the syndication space. I don't think we said that in the intro. Now, one interesting thing that you mentioned, the 24 units, that was, you didn't bring any partners. You bought this solely with yourself, but did you have any partners on that one?
No, I had a partner. Two of us bought one 24 unit apartment complex, $1.1 million transaction. We put 15% down. So we really didn't put much, we put like 85,000 each of us to buy that asset. It was a simple transaction, two of us, I saw that asset only once, it is far south. I can walk from my property to Mexico, in Texas, a great property manager handling everything. Yes, I had a partner in there.
And I'm sure that gave you the experience and the process of what it takes to actually acquire a multifamily. So that's great. That's awesome.
And where was this asset located, Prashant?
So that asset is located in McKinney, Mission, Texas, actually. Okay. Very, very close to McKinney, which is like southernmost town in Texas. And to your point, John, yes, learning is a process, right? I can talk all day long about real estate, buy multifamily, but unless you buy something yourself, you do not know what to expect. Those 17 days were very excruciating. Obviously, I was working full time at that time, but everything was compressed. I'm glad that it was not 3 months from December 9th to this December 26th or something. I closed the deal. Basically, I saw the property, I signed the contract, and then we did the due diligence. Bank was ready. They were motivated. They did the appraisal. Boom, bada boom. The whole thing got done in 17, 18 days. And that's it. After that, property manager took over the property. But during that time, you realize that you have to do the appraisal, you have to look at the bank, you have to talk to them, make sure that there's no discrepancy, you have to do the underwriting, you have to do the due diligence, making sure all the leases are correct, you have to get the inspections done, you have to get the environmental done, and many times those things take time. So some of those things you don't do in your single family, like environmental, you don't do that. You don't know what the environmental is, right? And if you go to Freddie and Fannie Mae loans, there are different requirements, KP, key principal requirement, net worth requirement, liquidity requirements, and whatnot. So you end up learning a lot from that, and I think that was one deal which gave me a lot of confidence that yes, I can do more. And I mean, after that also I bought a couple of assets. One asset I bought was 72 units just for myself, like in Indianapolis. I just bought it just for myself, nobody else.
That's amazing.
Yeah, so basic thing is you end up learning a lot, and you basically as I said, you get the money, you make the money in syndication, and then you invest somewhere so that that money can start making money for you too.
And that's exactly why we love syndication, because even your syndication operator is investing on its own deals back into real estate. So this is why we love the large apartment asset investment class for anyone listening, and it's extremely important. So that's a great story there, Prashant.
And Prashant, I know you mentioned right after that you realize like you want to go into this syndication. Like multifamily was definitely what you wanted to go after, and then you said syndication. What would you say are some of the benefits of a syndication as opposed to like a joint venture, which I know they're very popular here in Canada, right? There's a lot of joint ventures. I actually have a good partner of mine who has over 400 units of just all joint ventures. So it sounds like you have a mix, but your primary focus business is syndication. So what would you say are some of the benefits of the syndication as opposed to the JV structure?
Yeah, so syndication means you have more. If you are doing the syndication, you have more power, right? I mean, you are the general partners. So general partners and the limited partners. In a smaller deal, you can do a JV where everybody who's investing with you alongside you have the same rights. In terms, everybody is called the ownership. It's not like limited partner or a general partner. Everybody is a partner, basically. In syndication, you have limited partners where the equity is coming from, and general partners are the ones who are the decision-making authorities. I mean, if you have a bigger deal and if you have 50 investors, you cannot manage 50 investors if everybody wants to be the part of decision-making, right? And if it's a smaller deal, $1 million, $2 million deal where you have only 4 partners, you call that as a JV partner, right? Where everybody has the voting right, everybody has the voting right, but the person who's doing the work probably can take a little bit more from that, but everybody has the similar rights. So the main fundamental difference between JV and syndication are the voting rights, right? So a JV, everybody has equal rights or whatever rights you define, basically. In syndication, you have limited partners who do not have the voting rights, although we do listen to limited partners to understand their concerns, but the business is run by general partners.
And I think one thing that I wanted to add to that, which I think is definitely a great solid point, what do you think are some of the, like, I guess, when doing that structure, right, because the general partners have a lot more of the control, why do you think that would be important when it comes to like track record or experience, as opposed to maybe like a new limited partner who may not, maybe, they want to renovate the units, but it's not going to generate extra cash flow, whereas the general partner, they have that experience. What would you say?
Yeah, 100%, they're very good point, I mean, and that's in addition to what I said earlier, a general partner comes with the experience because they are the decision makers. They come with the experience, they have been doing this for a long time, they have the net worth, they have the liquidity, they do these projects day in and day out. Usually it is their full-time job and they know what to do. A limited partner can be anybody, or somebody who's busy. Typically it is somebody who doesn't know what to do, right? I mean, doctor, an attorney, or somebody businessman who doesn't know what to do in a real estate, but they have excess cash, which they want to invest and make money. So their primary motive is to invest and get some passive returns, where they don't need the headache. So general partner takes all the responsibilities. Limited partners have very limited, only exposure to limited partner is the equity that they have put in. But the general partners typically sign on the loans. They have bigger exposures, bigger risk. In a JV scenario, everybody has same exposure. Everybody has same risk level. Whether a JV general partner, a JV partner is working on the deal alongside with an active or inactive partner, they have same risks. They have basically same exposures. They have same responsibilities, same voting rights. So these are typically two different kinds of legal structures, so to say. A JV deal can be structured in exactly the same way as the syndication deal also. But you can say 80-20, but it still can be a JV deal. It is possible to structure the deal the way we do 80-20 in syndication. You can structure your JV deal also like that if your partners agree to that. It's a smaller deal. Let's say you have 5 guys, only 2 guys are going to work on the deal. The remaining 3 guys are just investors along. But it is a JV deal. They get the similar exposure, but the decision making is with everybody else.
Yes. No, I can agree with you 100%. Just to kind of talking an experience here, when we've had JV for some of our projects, anytime something comes up and issue comes up, there's always a discussion that has to happen with the JV, and it has to be agreement. And even partners that we have had a really bad scenario where there was a disagreement. Now they have to sell the asset. One partner wants to sell the asset. So I think by doing a syndication model, it allows the active, like you said, the active partners to be actively enrolled, and this usually is a full-time job for them, as opposed to somebody who's a part-time and they're not really fully committed to the project and the success of it. So that's a really good point. Now, another thing that I kind of wanted to get your feedback on is with the syndication, it really does become a more scalable model where you're able to consistently raise capital, find deals, whereas the JV, I feel like it's a little bit of a harder model to grow or to expand, because you always have to be looking for those JV partners. So what were your feedback on that, or what are your thoughts?
100%. JV is more of a transaction where you have to have similar kind of partners, similar mentality, similar cash. They can put similar kind of cash. Syndication is, you can open up the syndication for everybody and anybody in the world. You cannot do that on JV, right? It's not JV. The other part of JV is not SEC. It is just a partnership. JV is a partnership. It is not SEC regulated. You can have 5 partners, just create a operating agreement and do the deal. There's no SEC filing involved. But in syndication, you have to do the filing, 506B or 506C. That way, you have the authority to go raise equity from folks whom you did not know before. If it is 506C, if it is 506B, all the general partners can go out and raise equity from their friends and family members. But in JV, there is no need for SEC filings. It's not at 506B or 506C. However, you cannot advertise JV deals on internet. You cannot solicit investment from those whom you don't know, with whom you have not done business with in past. So yes, very different kind of mindset. I think it's more of a mindset thing. If you want to grow, you probably would grow more in syndication if you have deal flow and you have the investors. So what are the 2 things needed for a business? Deals and investment, right? Product and sale, basically. Product and sale. So you have deals, but you need investors. So you find deals and you find investors. You keep on doing both the things at the same time, right? And then you kind of bring them together to close the deal, basically.
That's why for anyone listening looking to passively invest in apartment syndication, it is extremely important that you partner up with an experienced operator to ensure that you're crossing all your I's and T's, as we just heard from Prashant here. Thank you, Prashant, for all of that. We're going to be exploring the benefits of apartment syndication, and I just want to ask you quick quickly, Prashant, as to why apartment syndications over any other type of asset classes, for example, stocks, bonds, or any other sort of asset class?
Basically, if you really look at what are the things that human need, what are the basic needs? Food, shelter, clothing, and medicine, right? So these are the basic fundamental needs. We are not into food business, we are not into healthcare business. I mean, although I am in healthcare business in terms of assisted living, but shelter is something which is the basic necessity, right? Everybody will always need. People can decrease their spending, they can buy cheaper food, but shelter would always be needed, right? Food is always needed, clothing is always needed. So whatever happens if you target those assets where you are talking about the human basic need, right? You have to live somewhere. So that's why we go into real estate, and within real estate, you go into an asset class which is least affected by economic downturns or recessions. So you want to safeguard yourself. That is the primary reason we come into multifamily. When recession happens, a lot of offices get closed during COVID. You saw it, that there are office spaces, millions of square feet of office spaces are empty because people started working from home. So multifamily is an asset class where, we have rarely seen the rents going down. There is always a demand, right? Whatever happens, you are going to make money in that. Just like the recession-proof asset class. And I think this is the best asset class. I can talk all day long about multifamily. When people lose job, where do they go? I mean, they go live in their parents' home, or they sell their houses, they move into the apartment. So apartment is always full, and for that reason, apartment rent never goes down. So, I mean, as long as your asset can produce income, even in tough times, you make money. That's why multifamily has been so popular. I mean, and to me, that has been the best asset class. I mean, there's no question about that in my mind.
That's awesome. And I appreciate that. And I can totally agree with you on all the points. Even if you look at COVID, when COVID happened, the government was giving people checks to pay the rent, as opposed to, giving them checks to buy food or buy clothes or any other necessity. So I can totally agree with you. Now, for any of our listeners, Prashant, that may not be familiar with a syndication model and what is the structure of it. I know we briefly talked about GP/LPs, but just for our listeners who may not know, what is the basic structure of an apartment syndication? Like, how do they work? What are some of the roles? I know we briefly talked about the general partner, the limited partners, and the sponsors, but just give the listeners a little background of an apartment syndication model and what is the structure of it is.
See, what do you mean by syndication? Syndication is basically you are raising equity. When you go buy an asset, you need some money, right, for your down payment, because most of the money comes from the bank, but some money has to come from the buyer. And that money can come from either the buyer himself or a pool of buyers, basically pool of partners. A syndication word means that you are, instead of only one person buying, you are syndicating the money from multiple partners. Those are called limited partners. They are not involved on a day-to-day transaction or day-to-day activity of the operation. And they may or may not be involved. But the point is, the equity comes in from multiple people. It could come from your friends and family members, or it could come from totally unrelated people. Somebody whom you have never met. I mean, if it is a 5 or 6C deal, you syndicate basically the equity. That's what the syndication means. You syndicate the equity of the general partners, and because that equity has come in, and that is used to do the down payments and used to do the other expenses on the deal, and that basically gives the ownership rights basically to all the partners. So let's say in a deal, if there is a, I just make it up, there's a $1 million need, and there are 10 people who invested into that deal. So that $1 million, the buyer who, let's say John or Jefferson did find a deal which is worth $4 million, bank gave $3 million, they needed $1 million, which they got from 10 guys. Those 10 guys are putting $1 million. That $1 million gives them ownership in the deal, right? So, and because John and Jefferson are working on the deal as a general partner, they have to make some money also. So, because of the fact John and Jefferson are working, they need some portion of the ownership as well. So at a very high level, let's say John and Jefferson end up taking 20% of ownership because of all the good hard work that they have put in the deal. They found the deal, they spent so much time, they are running the deal. So they're saying, okay, we are going to take 20% ownership in this. For the money part, those other 10 guys who put the money in the deal, they will own 80% of the deal. 20% ownership is John and Jeff, and remaining 1 million, 10 guys, they will get 80% of the deal. So, but that doesn't mean that John and Jeff have the equity. I'm just making it up. At the time when the deal is sold, the first is bank gets the money, then investors get their money, and then whatever is the profit, that splits 80-20 between investors and John and Jeff, who are the main owner of the deal. So it's not that Jeff and John put, in this case, they did not put the equity, so they did not get the equity back, but they got the profit back, So ownership in the profit, So ownership in the profit is split between investors as well as general partners. Typically, these deals are 80-20, 70-30, 65-35, depending on how much work is needed in those deals, right? Some deals are very tricky where owners work a lot. There they need to have a little bit more. As long as investors' returns are in a reasonable level, investors are willing to invest. They come in as limited partners. They work with general partners, and that's how deals are structured.
Awesome. No, that's great, Prashant. I appreciate sharing that. And one thing that I wanted to kind of add to that is that with the syndication model, it truly is a passive investment for investors that are going to be limited partners, because they don't have to do any of the day-to-day. Like you said, some projects it may take more, it may take the general partners more time because they have to be there, they have to manage the asset, they have to reposition it. So it really is a true passive approach to investing and letting your money work for you, and that's great. Now one thing that I wanted to ask you, Prashant, in this new environment that we are in, with the, interest rates going up, the number of sales being lower than they were in the last couple of years, what have yourself and the team at Cashflow Champs have done to mitigate the risk from the high interest rates? Because I know you guys are constantly, looking at deals, underwriting deals. What metrics have you adjusted in this new environment, just to help the listeners understand a little bit more about that?
Very, very good question, Jeff. So basically, because of the interest rate changing, the cost of capital from the bank side has gone up significantly, right? And because of that, we are, obviously we are looking at a lot of deals, but those deals are not penciling out, right? So a lot of assumption deals in the, where the loan was taken 2 years ago at a very low attractive interest rate of 3 or 4% or 5%. And if you find those deals and the numbers work out, we are able to get into those kind of deals. We have a couple of deals under contract. One of them we are closing soon. But those are assumption deals that are happening. Other than that, we have not been able to find A deal where if you put the new loan and make the numbers work, because at the end of the day, we have to make money for our investors, right? I mean, that is the biggest why. I mean, that's why we are doing this. So I mean, yes, we are doing deals, but most of those deals are primarily assumption kind of deals where the loans were prior to increase of interest rate, and they're fixed loan, no bridge loan kind of assets where the rates were variable. If the rates were variable, we would not be able to do the deals.
Yes.
Very important thing that, no variable rates, only the fixed rate assets, fixed rates loan, and most importantly, assumption loans, which were taken like 24 months ago. At that time, our interest rates were still in 3 to 4% range. So that's what are working out for us. A couple of deals under contract. We underwrite at least 50 deals a month. It has been very tough. I mean, the market has been changing constantly. You don't want to take any unnecessary risk. If you can avoid that, that's what we are doing.
That's great. Now, that's a great piece of advice, and honestly, that's what we've seen when we're getting new deals from brokers. The summable loan is something that's starting to become really popular. I don't know if it was as popular back when the interest rates were low, but I'm starting to see a lot of them. They're like summable loan at 2.5%, 3.5%, and the deals, like you said, are penciling out much better because of the new cost of capital. So that's a great point. And now, I know you mentioned this a little earlier, and I just want to kind of circle back to this, the importance of due diligence when evaluating a syndication. Because the first thing is obviously you analyze, you underwrite the deal makes sense. You put an LOI. If the LOI does get accepted, at that point, you guys will be on a contract, and then the due diligence starts. For any of our investors that may be listening, how different would you say, and I know you touched on it, is the due diligence on a multifamily, like a large multifamily, 100+ units, to a single family? And how much of that due diligence do the LPs, limited partners, have to do?
So LPs really don't have to do any work, basically. LP cut the check and they get the mailbox money. Nothing is. LPs have no responsibilities unless they really want to jump into a deal, right? So as far as the amount of work in terms of how much work it is to do that due diligence, it is considerable amount of work. I mean, think of, you are looking at single family, you look at the inspection, look at the house, what is wrong in the house, blah, blah, blah. Think of it doing it for 100 homes, 100 apartments. You go into each and every apartment, you look at each and every aspect of that apartment, making sure there's no funky thing going on, electricals, mechanical, sheetrock, bathroom, kitchen, there's nothing wrong. And if there's anything wrong, you write it down, basically. So you kind of combine, you do complete analysis of all the apartments for you, because you need that information so that you can go back to the seller and ask, negotiate based on the due diligence. So due diligence is, you want physical due diligence, then financial due diligence, and the location due diligence. So when you try to put an LOI, it gets accepted. Whenever you do the due diligence, it is good 30 days worth of work for you or your team to make sure that property is what it was supposed to be, is what seller wants to sell you, and most importantly, is that what you want to buy. So you want to look at everything in the due diligence. You want to look at the roofs, you want to look at the HVAC, you want to look at mechanicals, electricals, plumbing, asbestos, sheetrocks, construction quality, any deferred maintenance, parking lots, phone system, Wi-Fi system, TV, you name it. You want to know everything about your property. I mean, if you are investing a lot of money and if you are taking a lot of money from investors, you want to make sure you do your due diligence correctly.
That's correct. And
this
like you said,
this is what's all being done by the general partners. This is all the work that's being done by the general partners to ensure the due diligence, to make sure that they are returning a very profitable investment opportunity to their investors and making sure that everything is said and done. So that's great to hear.
And one thing that I wanted to add to that is sometimes, either ourselves or I heard other syndicators, they'll have some of their investors say, well, you're not investing any money. Why should you make any profit? Or why should you, make an acquisition fee, which is usually how as a syndicator you get paid or you get compensated, but they don't really see all the work that goes in when underwriting deals. Like you say, you're looking at 50 to 100 deals a week or, every 2 weeks, which is a lot of deals, a lot of time being spent on that. Then on top of that, you're doing due diligence, which now you're going to the property, you're traveling there, you're spending time away from your family to make sure the asset makes sense. And something that really stood out from what you said is location due diligence. That's not something that I've heard before, which I really like that, because something might look great on the outside, but kind of when you go there, you see what's really going on. So talk to us a little bit about that. That really stood out to me, location.
Yeah, location is important piece, right? I mean, depending upon what you are buying, you want to check it out. I mean, if it's not a D-class area, it's not a war zone kind of area. So you want to, I mean, it's actually the most important piece of the puzzle is the location. I mean, is it a real A-class asset in an A-class area? It's a B-class asset in an A-class area, a C-class asset in a B-class area. So you want to find out, what is the vicinity? I mean, in terms of, who are the employers in that area? I mean, what are the jobs which are moving in that area? And what is the demography of the tenant, and what is your business plan? Are you planning to change the demography of the tenants, from B to A or C to B? So that location piece is very important. I mean, that's the most important piece actually. I mean, besides the financial due diligence and the structure and the physical due diligence, location is the most important piece, because real estate is all about location, and location. So once during the due diligence, when you go see the property, you are not just going to see the property, you are driving around to see what is out there. I mean, are there properties which are in shambles, we need more deferred maintenance? Where do you stand in terms of comps? What are the nearby apartments? Who are your competitors? How much are they charging? How are you going to get what you are going to get from this deal?
Yes. And one other thing that I want to add to that is, one thing that we like to do is we like to see where the nearby Starbucks, Walgreens, and some of these major companies, Costco, right? And you want to see how far they are from the property, because they do a lot of due diligence before they set up their offices or their stores. So that's definitely something I wanted to add to that. But awesome. No, I appreciate sharing that, Prashant.
And I want to mention for passive investors, if they're listening here, to think about investing for the first time, I want to talk about selecting the right syndication team. Can you give us some highlights of the importance of a strong syndication team in ensuring the successful investments for LP partners, and why also, Prashant, did you join Cash Flow Champs, and the importance of having a strong team?
See, fundamental is if I have money in my pocket, am I just going to give my money to somebody who's not strong enough, who doesn't know what they are doing, right? What is most important for me when I have money is to preserve my capital and gain maximum out of it. And both of these things can only be achieved by a strong operator, right? You want to look at operators who have been in the industry for some time, who have track record of giving certain returns. Higher return is not the goal. The goal is to preserve the capital and have consistent return. Even if it is a little lower, it is okay, right? Why would I worry about 25% return when I could invest it with somebody? They are giving me 20% return and they are consistent, right? So the fundamental thing is, it is a strong fundamental thing is that I should look for somebody who has done it time and time again in past. Although the future is not guaranteed, but at least they are morally strong team. That's the most important thing. What is the character of the team? If the folks are crooks, you can give them money, they can make money, and they can run away, right? I mean, that could happen. I mean, it doesn't happen that often, but it could happen. People they do weird things. So you want to go into a team which has solid track record, has solid financial background, and which are experienced in doing what they are doing. So, and that's the reason, I mean, like, we put together our team. We have very strong acquisitions team. We have very strong partners whom we have worked in past. So we formed Cash Flow Champs. I mean, we spent a lot of time together on multiple deals over the last couple of years. And then we realized that we should form a team which can do bigger things together, right? Yes, we can do one-off deals here and there ourselves, but the goal, if you want to grow and scale your business, you have to come together as a team and then take your business to the next level. And that's why I said, we are a strong acquisition team, we are strong underwriters, we are strong asset managers, we are strong marketing presence. All that is needed basically in a right syndication team.
That's great, Prashant. And I agree. It's kind of like putting an all-star team together, right? You got yourself, you got Charles Seaman, you got Paul, you got all the big hitters. So you guys kind of come together and form a like an NBA, like a superstar team. So that's phenomenal. And no, Prashant, for somebody new, I know you touched on a couple of these points, but for somebody new, what are some tips and guidance when evaluating syndicators or sponsors? I know you talk about track record, you talk about morally, they have, you can connect with them on a morally level. What are other tips for a, passive investor that's evaluating, looking at different syndicators and sponsors?
See, for passive investors, the most important thing is to know the syndicator, right? I mean, they should know whom they are investing with, because, I mean, they are trusting their hard-earned money for somebody to invest in a deal. So that's the most important thing, is that you know somebody, you have built a trust level over a period of time, and for them to see the track record. You go to their website, ask for the track record. How many deals have you done? What is the return that you have provided to your investors over a period of time? What is the level of returns? What are the cash flowing deals? What were the profiles of deals that they have done? So all that needs to be vetted, right? I mean, it is an important piece that passive investors should look for syndicators, multiple syndicators, and everything is open right nowadays. You can go to Facebook, Google, and you can find 10 different syndicators. And sometimes you join smaller boot camps, like the hundreds of boot camps that are happening every month. One should attend them and try to understand what it is that they should look for in different the hundreds of deals out there. Passive investors should vet those syndicators thoroughly, and then trust hard-earned money to be invested in those deals.
That's great. That's great piece of advice. And one thing I wanted to add, or rather ask you, Prashant, obviously, us being in Canada, one of the reasons why we went into the States in terms of apartment syndication is because they have the inventory, and you as the landlord, you have a lot more of the control. Now, I know you're in New York, where it's a little bit more tenant friendly. How important would you say it is when investing in a syndication or a multifamily property, where you as the landlord have the control, you as a landlord can, work with the tenants a lot easier than when the tenants have all the control, which is what we face here in Canada. And one of the biggest struggles when you purchase a multifamily, rents are $700, but the rents should be $1,600. But to get from there to there has to be an exchange of money to the tenants, to say the least.
Yeah, no, so that's a very good question. And in United States, fortunately, we are able to change the tenant, we can increase the rent based on the demand and supply, right? I mean, the demand is more, you can increase the rent, and you can bring your rent up to the market level easily. I mean, you wouldn't go to the rent controlled areas. We have many places like New York City, you cannot just raise the rent left and right. So in this business, we try to remain away from all the regulations. Let's just put it this way. Try to keep ourselves into the areas where it is least regulated, less government intervention is needed. But I mean, of course, the residential piece is regulated in the sense that there's certificate of occupancy and stuff like that. But in terms of rent increases and all, we go to the states which are more landlord friendly because they want landlords to continue to do more and more business in those states. I mean, that's why we go to those states where we have more control. It's all about control. If you lose control to the tenant is not going to give you the rent, It's just not going to happen, That's the human psychology. And nothing against, I'm just saying it, that if I were giving an opportunity that I should not, where I may choose not choose to give or not give the rent, I probably will choose not to give the rent, right? So I mean, as simple as that. So we get into a state where states have authorized landlords to file eviction, and the evictions are processed in a very timely manner, so that tenants are scared of those kind of things, because once you are evicted, it goes on your record also, right? It goes on your record, it sits with your record all the time. I rent my property all day long, and I look at tenants which are not evicted before. You don't want to see those records on their profile, right? So tenants, we go into those states. It's very important for us to do the business in the states where it is least regulated.
Yes, no, I completely agree. And just to kind of give people a little bit of more perspective on it, in Canada, it could take up to 8 months to a year before you can get a tenant who hasn't paid rent, which is just bizarre, right? As you can imagine, if you buy a 100-unit building, which there isn't really any, to turn over those units and to have so many tenants not paying, you're not able to execute your business plan as smooth and as much as you're able to do it in states where, when the leases come up for renewal, you give them the option to stay at a higher rent, or or essentially they have to leave, and you're going to renovate and make the building a lot better. So something I just wanted to add. Now, as we're kind of wrapping up here, Prashant, we just wanted to let the audience, or share with the audience a little bit more about what are some of the live deals that you got going on. I know you say you have a few on the contract. Just give the listeners a little bit of a little bit of feedback on the kind of deals, because I know you've done in the assisted living space, and you also have a deal in Atlanta. So just give the listeners a little bit of background on that.
Yeah, we have many deals going on right now. We have one deal in Sierra Vista. That is my personal deal where assisted living project, 150 unit, that hotel that I converted into assisted living. It is in a lease-up phase. And another assisted living project in Connecticut, 60 units. It's in construction phase right now. Besides that, we have two multifamily deals in Atlanta. One is Decatur, basically 236 unit. The three important things about that deal are the rents are, the interest rate is very low, 3.5%. Number two, the rents are below market. And number three, it's an upgraded unit, so upgraded, 100% upgraded inside, basically. So with very minimal capex. So
wow,
we are getting 2022 or 21 interest rates on this deal, and that's an incredible deal with about 2x returns in 5 years. That's number one. Atlanta, and number two, there's another deal in Atlanta that we have under contract. We have not launched it yet. Similar structure, 1.85 to 1.9 times returns in 5 years in Atlanta.
Wow.
So two deals, multifamily deals in Atlanta, and I have two other assisted living projects. So our hands are full, basically.
That's incredible. And I know last time we chatted, or maybe a few months ago, you kind of showed us assisted living, and you kind of showed us some of the benefits of it and why it's such a strong vehicle that it's going to continue to get so much demand as people get older, and as that age group starts growing, like it's growing at a tremendous speed. So tell us, just kind of as we're wrapping up here, tell the listeners a little bit, and just I don't want to make sure I miss that. So you said interest rates are 3.5%. renter below market, but is also upgraded inside. So because a lot of the value add buildings, you're doing a major capital expenditures. This one's actually already renovated, renter below market, and interest is at 3.5%. Is that correct?
That is correct for our multifamily deal. That's 97% occupied. But coming back to your question, assisted living, there, let me tell you, in assisted living, a silver tsunami is coming. There are 5,500 people who are going into assisted living, who the demand is increasing 5,500 people a day.
Wow.
The supply is nowhere near to that. Demand in assisted living is big. People are going into that age group, 5,500 people a day. You can imagine about 2 million people are. I mean, I don't know what's the real number, but 200,000 number of people are going into that space. But the supply is only 25% of that. So everybody's aging,
wow.
But we are not creating enough supply in the assisted living space. Over the next 10 years, the demand will still continue to grow, but the supply is still at the lower level. The gap is increasing. So that gives us a lot of opportunity for for the rents in the assisted living space to go up even more. I mean, yes, it's a high dollar, little riskier, it's an operating business kind of a model. But if you have done it once, you can replicate it again and again. The key is to find the right lender and who can lend the money on it. And then you can operate that business, and that can give you 30%. I mean, you're talking about $5,000 to $10,000 per room per month. If you make 20-30% profit on that, you can imagine how much money can be made in a system.
That's incredible.
Is it going to increase? Yes, it is going to increase. And that's not the real reason why I am doing it. I mean, business is one part. There are three things: why, how, and what, right? What is assisted living? How am I doing these operations? But why I'm doing this is what is the most important, right? What is your why? I personally come from a very humble background where I have taken care of my grandparents. I have taken care of my grandmother until the last day. They were like 82, 85, and when they left, us. I took care of them. So I come from that humble background, and that's my value system. I could not take care of my father, who passed away about 2 years ago, but he was not in that mode. I mean, he just disappeared, something happened and he just boom, he was gone. He was not old. It was not expected. The point I'm trying to say, my heart comes to help I get connected very well with elderly folks. I'm and that's why I came into assisted living. I started assisted living about 5 years ago, by the way. I have three assisted livings in California, which we have been operating. But now I'm going into the bigger model where, hopefully I'm able to help these the seniors who have given their lives for their kids, help them out, give them some smile so that, I bring some change in their lives. And I have the firm belief when I give something to somebody, especially to these seniors, I mean, when I give something, there's a law of reaction. I always get something back, spiritually, physically, whatever you want to call it. And that's why I'm doing it. And I'll continue to do that,
Wow. No, Prashant, that's very meaningful. Is that something you hear every day? And it really goes to show you your character and what you're about. We're actually in a similar boat ourselves. Our grandma has Alzheimer's, and we've kind of gone through the process of seeing what that's like, taking care of your parents, your family. Not only that, but on the business side of things, assisted living, the more we learn about it, the more we learn that the demand is crazy, the rents are crazy, and then these people are not affected by the market. Like, if there's a COVID that happens, it doesn't matter what happens, because these people, they're usually not working, they're usually retired. so they're not going to be like turning over units every month. You know what I mean? And you don't really have to worry about where the environment is or where the market is, because these people are usually already retired, so that doesn't really affect them. And not only that, but some of the, you know, I think we got a chance to look at the Hummingbird, the Arizona deal, the assisted living, and it's a really beautiful assisted living complex. Like here in Canada, because it is the winter, you don't have those amenities that you have in Arizona, you know, the outside, the movies, all the other benefits of it is very plain and simple, the assisted living here, which I think is one of the great things about the US.
Oh, that's true. I mean, you have to find, you know, seniors are a lot of seniors are affected by the cold. So you have to find a place which is warm, which can give them cozy feeling and give them a resort style, you know, amenities. These are the last stages. I mean, not last stages, but these are the last years where we want to make their lives of our seniors as comfortable as possible.
Wow, very, very meaningful. With that, Prashant, we are pretty much all wrapped up here for today's show. We're really thankful that you were able to join us today and give our listeners so much value. I'm sure they're going to be getting major value from this interview. Now, just for the listeners listening here, what's the best way for any listeners that are listening to reach out to you, reach out to the Cashflow Gems team? We will attach your like your social media links, but what is the best way to contact you?
The best way to contact me is to send me an email, send me a text, or connect me on social media, you know, prashant@cashflowchamps.com. Go to cashflowchamps.com and you know, schedule an appointment with me, or drop me an email. I'm just an email away, you know.
That's awesome. Yeah, and for folks that don't know, we host the Cashflow Gems meetups in Toronto. For anybody in the Toronto area, we also host webinars, monthly webinars. So we have a pretty, you know, tight relationship with Cashflow Gems, as you know, you guys can tell. You know, we love the team there and we love everything that they stand for. So just as we wrap up here, we'll just let folks know a little bit about what the episode was about today. Some of the things that we covered, exploring the benefits of apartment syndications, understand the apartment syndication model, assessing risk and return potential with the market that we're in, selecting the right syndication team, and the strategies for passive investors in the syndication, and then the live deals that Prashant was able to share with us. So with that, we encourage our listeners to reach out for further information, schedule a consultation call, or explore investment opportunities. And again, we thank you, Prashant, for your valuable insights and contributions. For anybody else, stay tuned for more episodes. Make sure to join our newsletter, webinars, meetups, and podcasts, and enjoy the journey. Anything else, John, you want to add to this?
No, I mean, I thought it was an amazing podcast. So thank you, Prashant, again, for your time and attending today. Again, we are the bridgeway for passive investors that are in Canada that want to invest in the US. If you have any questions, we will put our information below, and we look forward to hearing from you. And stay tuned for episode number 3 sometime in the next couple of weeks.
John and Jeff, thank you so much for your time. Thanks for inviting me today.
Thank you, Prashant.